All right, so we're just before our last session before lunch. Come on up, gentlemen, and we're going to reset the stage for you real quick. But I hope that first panel or that last panel that we just did there really answered some of those questions that you guys had around the markets, where to be investing, and what's going on. Coming up next, we have a unique session, which I'm hugely excited for. It's not every day that you get to hear from the president of the New York Stock Exchange, let alone the first female president in the history of the New York Stock Exchange. That's 226 years of history, and we have the unique opportunity today to bring Stacey Cunningham onto the stage. So if you give us 1 second, Matt, we'll get these last two chairs off, and then we'll get you guys on. But this is going to be a fast-paced session. Matt has 10 questions for Stacey that she's going to try to answer in 20 minutes or less. So we'll be ready to go in just about 30 seconds or so.
Thank you, everybody. It is a real delight to be here with Stacey Cunningham. Stacey is president of NYSE Group, which includes the New York Stock Exchange and a diverse array of equity and option exchanges, all owned by the Intercontinental Exchange. She is the 67th president and the first woman to lead the NYSE Group in its 226-year history. Prior to being named president, she was COO. Before that, she was a floor trader. Before that, she was a clerk. Everybody give a warm Inside ETFs welcome to Stacey Cunningham.
I have to just say one thing. So it's NYSE Group, and the reason why I say it is there's a really funny Twitter feed. If you follow NYSE on Twitter, there's this whole conversation about how many people say NYSE versus NYSE. So it's NYSE Group.
NYSE. I will never make that mistake again.
If you read the Twitter feed, you definitely won't.
Awesome. Well, the way this format works is we have exactly 20 minutes. It counts down to 0 and they kill our mics. We're going to go through these 10 questions. It's going to be fun, fast-paced, and exciting. So if we can put the clock up on the screen, that would be great. And we will kick off our session right now. So, Stacey, when you got this job, your CEO, Jeffrey Sprecher, told you to go reinvent the place and that nothing is sacred. To me, you know, in this room, maybe that's an excuse to finally shut down the floor. Some people don't think it's that important. It's just you and me in this room. So does the floor really have a future?
The NYSE trading floor is the keystone to NYSE's unique market model because the combination of humans and technology is so much more powerful than either of those on its own. And it's really been an evolution if you look at how the floor has evolved over the past few decades especially, and with the market structure evolving too. So now technology is integrated so closely into what the people on the floor are doing every day, which makes their jobs much more scalable, which makes us positioned for the future. And as a result, it leads a better result for our issuers and investors that are trading there every day. So the floor trades with much less volatility, and the NYSE market model trades with much less volatility, which we saw a lot of towards the end of the year when volatility really picked up. You really see that value, and the companies that are listed on the NYSE traded with 40% less volatility than companies listed elsewhere.
That's a nice number.
It's real money.
That
it puts
is a
money
nice
back
number.
in.
Now you actually brought ETFs onto the floor. ETFs have never been on the floor. So you actually brought them onto the floor. What does that do for the people in this room? So
traditionally, the New York Stock Exchange only traded stocks that were listed on the New York Stock Exchange. And that's something that we changed last year, so that we could list everything that was listed in the US, and we would trade on the NYSE. What we're doing this year is actually really exciting, because for the first time, we're going to list ETFs on the New York Stock Exchange model itself. And so that we're starting with fixed income ETFs, and we filed to do that. And what that means is that issuers get that same human oversight with the trading of their securities and their products, which is especially important when you look at the market open and close and events throughout the day when there's volatility.
All right, 2 minutes in. Let's go to our next question. This is a room full of financial advisors. What's the single most important initiative that you've done at the NYSE Group to help the people in this room?
You know, we're always talking to our customers to find out what's important, what are their challenges, what do they need to do, how can we help them, and how can we help them be more successful. So one of the things that comes in a number of different ways, but one of the things that we introduced this past year in 2018 was we changed the official closing price on NYSE ARCA. And that's how, very often ETFs will come to market. They're not all actively traded. And as we know, some of them are less liquid and they might not trade for days. And the way the official closing price worked was it would be based on the last trade. But that last trade may have been days old or even weeks old. And so it wasn't really a clear valuation of where NAV was. So we changed that official closing price so it's more closely aligned with NAV and where the product is being quoted at that point in time, which means that FAs have a much better view into what the actual value is of their portfolio, and their wrap fees are more appropriately allocated. So that's an important change. And if you look, since June of 2018, when it was rolled out, the NYSE ARCA official closing prices are 59% closer to NAV than those on NASDAQ and 97% closer than SIBO. And so we patented that process because we know it gives our issuers a much better closing price.
All right, very cool. Let's move on. One of the big things that ETF geeks like to talk about and worry about, indeed, is the SEC's so-called transaction fee pilot. Can you describe what that is, what it does to the ETF industry, and why it's received such a mixed reception among ETF issuers?
Yeah, the New York Stock Exchange has been a really vocal opponent to the transaction fee pilot. It's important to understand that this pilot was conceived of in a very low volatility environment. And what it does is it puts stocks and ETFs as well into different buckets. And in each of those buckets, the SEC has set parameters over how exchanges can set fees and provide rebates. And right now, we actively use rebates or payments as incentives to make sure that market makers are making better quotes in products, and so that investors are getting better prices. It's been a really effective tool to deal with a fragmented marketplace. But when you see how fragmented the market is, and especially when volatility picks up and you see a lot of liquidity come back to the exchanges, we want to make sure that we're able to provide enough resident liquidity there. What the SEC is doing is saying, hey, each of these products will be in different buckets for a 2-year pilot. And we're concerned that it's going to pick winners and losers. I mean, already on the public company side, people are competing, aggressively, and we're trying to make sure that companies continue to come public. And on the ETF side, you might have 2 very similar products from different issuers who are in 2 different buckets during a 2-year pilot, which ideally, the view is that it's going to have an impact. So either the pilot has no impact, and then why are we wasting our time and introducing this complexity? Or it does have a meaningful impact, and now we're going to end up picking winners and losers. And I don't know if any of you have been launching ETFs in there. I mean, having a structure that don't have control over and your competitors are in a different one, I think would be a challenge for a 2-year period.
Yeah, I loved your comment letter to the SEC, which said ETF issuers support the proposal, but most have reservations about applying it to their own products.
Yes.
Sort of like NIMBYism in ETF land.
Yes, we love it, just don't put ETFs in it.
Exactly. What should people do in this room if they want to have an impact on the progression of that transaction pilot?
Use your voice, right? You can write letters. So what the SEC did actually adopt the pilot because the government is shut down. Yet we haven't heard an implementation date. But I would make sure you're using your voice as there are opportunities arise for you to speak out against it if you're concerned. Okay, we're doing pretty well. We're about 20 seconds behind schedule, but that's okay. Let's do an ETF speed round. Non-transparent ETFs, when are they going to happen? When, again, if we can keep the government open is a big part of that, and Friday is a telltale date. But I think what's important to note is how quickly the ETF industry continues to evolve. If you look at this room, I mean, it was only 25 years ago the first ETF was launched, and we partnered on that. We've been a vocal participant in the ETF industry, and for that reason, NYSE ARCA is the home of ETFs, and we have been for 25 years. But it's not an industry that's standing still. I can't imagine that you'd look back 25 years and expect that you'd have so many people here at an event. And non-transparent is just one more evolution of the ETF landscape and where we're going. So we have patented IP that offers clients an opportunity to take an active fund and put it into an ETF wrapper. That's one thing that we think is coming, but we're waiting for the SEC to keep moving. Okay, next one. The rise of RFQ platforms has been significant. A lot of people trading through RFQ platforms. Is that a threat to the exchange? How do you think about that market? What's the impact? No, I think there's a lot of opportunity for us to work together to solve industry issues, right? So one of the things that we just recently announced, and frankly, the New York Stock Exchange is owned by ICE as the parent company. ICE has its background in making markets more efficient finding issues that are out there, looking to introduce efficiency and transparency. We recently announced a partnership to launch the ETF Hub, so that we can make the creation and redemption process more seamless. And it's going to focus on fixed income ETFs, but it allows issuers to use customized baskets and have an easier time of going throughout that process. So it interacts with our RFQ platforms as well. So I think that the ecosystem will come together and be more efficient.
Last ETF specific question. Do we need a separate solution for low liquidity ETFs? One where people can get access to better executions than they're seeing in ETFs that only trade occasionally. Is there anything we can do there?
I think there are things we can do around the edges to help ETFs that only trade occasionally. And the official closing price is a great example of that. Is how do we solve some of the issues for some of the less liquid products? It's something we're very focused on. It's also why we're rolling out the DMM model that NYSE offers for some of the less active ETFs.
All right, let's look big picture. We were talking backstage how exciting it is to talk about new companies going public, but there's this perception that fewer companies are going public. I guess my tie into that, is that true? Does it matter? Do we need to change it? And we have a little bit of data on this, which suggests that what's happening is the number of large companies going public is staying about the same, but smaller companies are having a hard time coming to market.
Yeah, the number of public companies is down by half over a 20-year period, which I hope matches your data. And the average size company is 6 times what it was before. So we've created a marketplace that works really, really well for big companies and big investors. There's a lot of access to private capital, so companies have choices now. They can decide, why not I wait to go public when I can have teams that can deal with some of the regulatory issues that are there. There are also pressures from investors to meet short-term goals and manage to quarterly targets. So there's some flexibility that the private markets offer. And so companies are taking advantage of that. That's certainly one of my biggest focuses right now. We want to make sure that things are in balance because the benefits of the public markets are really tremendous. And you see a company like Spotify, who last year didn't need to raise money, and they didn't need the brand and recognition that public markets can bring, but they saw the value in the public markets. They wanted liquidity for their early investors, and they wanted to have access to capital currency so they could do M&A, which they just announced their first deal last week. So they came public without doing a traditional IPO. And in fact, they came to us a year and a half earlier and said, hey, we have this crazy idea. Can you help? And so we worked on that for a long time with them. We worked with the SEC on getting that filed. So the point is, there's value to being public. We need to make sure that that balance is key. And that's really the right structure, that investors and issuers' interests are balanced so that we're attracting companies to the public markets. Because what I really think is of an important note, I think it contributes to the bifurcation of wealth in the nation when investors are missing out on the most significant growth trajectory of public companies that are staying private when they're growing most quickly.
All right. I had a follow-up, but we're a minute behind, so I'm going to keep going. Should we allow companies to go public with no voting rights? We saw things like Snap. There was a big discussion in the index industry. Should we even put those in indexes? Should that be allowed?
See, it's a great question, and it ties into what I was just talking about. These are the types of things that we're looking to prevent in the public markets, but the alternative is the private markets. So if people don't like, a founder might not like the idea that they're going to lose voting rights if it's one share, one vote, they can just stay private, which ends up meaning that investors have fewer choices. So our view is provide disclosures, provide transparency, give investors the tools so that they need to make educated and informed decisions, and then let the markets decide. And I think it's also overstated a little bit. If you look at 2018, 9 out of 10 companies had one share, one vote structure. But it is something that I just get concerned about the impact if we start putting more and more restrictions on public companies and keep losing that balance.
So let the market decide.
Let the markets decide.
Okay.
We're lucky that markets get to decide, and that we live in a country where investors have choices and markets get to decide what pick winners and losers.
All right. Let's go to the next one. This is a fun one for you. The SEC recently blocked a proposed increase in the fees charged by exchanges for data. So the question is, are data fees too high, and what's to prevent them from going higher?
So what the SEC actually did was they put out a ruling that exchanges need to provide more information when they're filing data products. And so they actually went to great lengths to say that they weren't making the statement that fees were too high, but that they wanted to make sure they understood why fees were set the way they were. It's something that we challenged because it is a very competitive marketplace. There are a number of exchanges out there. We operate 5 different equity exchanges. We have data feeds for each of those 5 exchanges. Not all of our customers take all data from all 5 exchanges. It's a competitive marketplace, and we, again, believe the market should decide where there's value in a product. And I also think the shift in the value of market data has been so dramatic since the markets became more fragmented. So if you needed to show up to a place where, if you go back 15 years, 85% of trading would happen on an exchange where a product was listed. Now that's trading across 60 different venues, both lit exchanges and dark pools. So you're taking market data to stitch the market back together. And that's an evolution that's really been exacerbated with Reg NMS. And I think market data, the fees of fixed costs are a byproduct. Right. Important to note, the all-in cost to trade is lower than ever, right? I mean, I could ask this room, how many people feel like their costs have gone down over the past decade? Sure. And I would think most people would say yes, and ETFs have been a driver in that as well.
For sure. All right, moving right along. Will we see another flash crash?
I think that the market structure evolution plays a role in volatility. And the markets, because they're more fragmented, do lead to more rapid market movements when you don't have centralized liquidity. What we've done as an industry is come together to find ways to limit those market moves, and things like the limit up, limit down program. We learned from that, we improved on it, a number of different things we put in place. So I think there are protections, and there's also education. It's important that people understand how to trade in today's markets.
If you were an investor, would you put a sleeping stop loss order into the market, or is that a order that should simply go away from the brokerage side of the equation and never be used by anyone ever again?
Well, I think while stop orders, I'm sorry.
That's all right.
They're meant to limit losses. But in today's fragmented world, you can't expect that behavior. So while they might be useful tools, some percentage of the time, the risk associated with them is so large that I personally wouldn't use them. And I think the same is true for market orders. Very often, you'll see that people will look at the quoted price and think, oh, I'm happy to pay or to buy or sell at that price. I'm just going to send in a market order.
Yep.
They don't really have a market order. You have a limit. If there's a price where you're going to call your broker and complain about your execution, that's your limit.
Right.
So just make sure you have it on your order.
Great. We're doing well. 3 questions left because we have a bonus question in here. Your parent company is launching a digital asset exchange called Bakkt. Bitcoin is down 75%. As Dave pointed out 8 times, I work for a crypto startup called Bitwise. Is it time to pay attention to Bitcoin, or is it over?
Well, I'm sure you have a vested interest in this as well.
I do.
But where I think we need the infrastructure in place to be able to use this as a valuable asset. And so what we did was we teamed up with Starbucks, BCG, and Microsoft, and we launched Bakkt. And it's a company that's designed to enable the buying, selling, storing, and spending of digital assets. And it introduces institutional grade know your customer protections, as well as secure warehousing. We also just recently announced an acquisition while we're waiting for CFTC approval to launch it's based on a physically settled one-day Bitcoin future, which is the first phase of the project for Bakkt. But we recently announced an acquisition. It's a set of assets from Rosenthal Collins. And so Bakkt's recent acquisition is all about the consumer and the infrastructure needed to enable consumers to use digital assets.
All right, and are we going to see a Bitcoin ETF this year?
If we keep the government open, we have a higher success rate than not, but hard to answer that too.
All right, that's great. We have about 3 minutes left. I have a Stacey Cunningham speed round.
Okay.
So these are a series of 6 questions. Which you can answer very quickly. One thing people don't know about you, you've been both a floor trader and a chef. It's hard to imagine 2 more high-stress environments. What is it that attracts you to these places that are terrible to work?
They're actually very similar environments, and if you work on the trading floor and you work in a kitchen, there are a lot of similarities. One, you have to learn to communicate very clearly and very quickly. You learn to work together as a team. You learn a lot about how to address issues and problem solve quickly and move on. So those are things I just like the pace of it.
All right, what's the best thing you cook?
I like slow cooking, so my most requested dish is probably pulled pork.
Pulled pork, all right. What's the best book you've read in the past year?
Hard to pick a best, but I'll tell you the one I just started. I'm reading a book called The Island at the Center of the World, and it's an interesting piece about the Dutch version of the beginning of Manhattan. And that's sort of lost from the dialogue when you talk about how New York City was founded, so it's so far off to a fascinating start.
That's awesome. What do you do for fun?
I like to go hiking
All
and eat.
Who is your most important mentor?
You know, for me, there is not just one mentor. I feel like it's so important to learn from everybody around you, whether they're above you, you know, they work on different teams, on part of your team. So I've been really lucky to have a lot of mentors throughout my career, and that give you a lot of good advice, and I tap into that as often as possible.
What advice do you give to you 10 years ago?
You know, I think it's important to embrace ambition and to reach out for opportunities. I tried to turn down every job I ever got, and I probably wouldn't do that again if I, had that advice 10 years ago.
All right, last speed round question. What's one thing people don't know about you?
Well, if I told you, I would be
come
giving
on.
away my secrets. I can't answer that.
All right, we'll give you a pass. Last question, you have 75 seconds to define your legacy. You're the 67th president of NYSE. The average term historically is about 3 years, so that's out there. What do you want your legacy to be when you leave, whether it's in 1 year, 3 years, or 20?
I'd like to create a market that supports long-term ownership and long-term views, and getting that balance back in place so that companies can attract long-term investors and successfully lead their businesses that way.
All right, and what's going to make that happen? What is on your docket in the next year to make that a thing?
I think that we need to make some shifts in how we reward long-term investments, and we have some ideas on that front.
All right, last question. You have 1,000 advisors in the room. They're facing a new and difficult market. What would you tell them to focus on in the year ahead?
Yeah, I think educating yourself on how markets have changed is really important, because we shouldn't assume they are the same. And so things like not using stop orders, not using market orders, are things are important to understand. So I just would make sure you're keeping up to date on why market structure actually impacts how the markets have evolved.
Ladies and gentlemen, Stacey Cunningham.
Thank you. Thanks, Matt.
Thank you so much. All right. Thank you very much. We've now reached the midpoint of the day. There is lunch downstairs. It's a fantastic session. Just down the elevators and behind you, you'll get there.